Okay, so this is Finance451 Fall 2016 company analysis, Bloomberg project. For my first industry, I have the class industry, the oil and gas industry, consisting of ExxonMobil, Chevron, ConocoPhillips, Hess, and Marathon Oil Corporation. And then for my second industry, I have the food major diversified processed and packaged goods industry consisting of General Mills, Kellogg Company, Conagra Brands, Campbell's Soup Company, and J.M. Smucker. So the first industry we're going to look at is the oil and gas industry, my class industry. Their current ratio, ConocoPhillips has the strongest performance I found in the past 5 years at maintaining their ability to pay off their short-term debt, whereas ExxonMobil shows the worst slash highest, but the most improvement at 1.29 to 0.95 current ratio, indicating that they may have some working capital problems. ConocoPhillips is the shortest term solvent with the best quick ratio at 1.07 to 0.83 over the past 5 years. Across the board, all five companies have a dangerous cash ratios for solvency for their current liabilities, but Hess Corporation I found has the best ties of the group at 0.29 to 0.41 in the past 5 years. My conclusion being that ConocoPhillips is the most short-term solvent. So looking at their long-term solvency, all companies have had their TDR ratio increase, with ExxonMobil at the lowest with a 0.09. ExxonMobil is not showing signs of not taking advantage of leverage, which magnifies gains, having a low amount of cash currently. All companies do a satisfactory job not financing their assets with too much debt. Hess Corp shows the greatest sign for improvement on their TEIR status from 1.05 to 1.84, improving credit. Others fall short around 1.10. Just touching on their total asset turnover, Chevron I found had the notable asset turnover, total asset turnover, but only around 0.12, with the ratios steady throughout the year. However, low total asset turnover seems to be the norm for the oil and gas industry as a whole. So their profitability, breaking down the industry's ROE, all companies' ROE varies greatly on average and has been very volatile over the years. ExxonMobil holds the largest ROE currently at 6.21%, whereas ConocoPhillips struggles greatly at negative 11.29%. Most of this is due to a high tax and interest burden in the high 90s and poor management with a low PM and total asset turnover at 0.04 and 0.028 respectively. ConocoPhillips has had the largest swing in profit margin from a high of 36.46 and a low of 6.56. Marathon seems to have kept their margins the most stable with only a 4.86% swing. ConocoPhillips has a negative return on assets this year with a good record of accomplishment of a high steady ROA. Chevron seems to have the lowest ROA with dips such as negative 3.56 in 2012 and negative 0.55 in 2013. Looking at market value for this industry, Chevron has the highest price to equity ratio to date in 2015 at 36.72. Both ExxonMobil and Chevron's economic value added has decreased drastically from 2011 at 8,980.072 of an EVA to 2015 at negative 12,084.71 and 7,000 14 7,141.82 to negative 23,058 respectively for ExxonMobil and Chevron. Hess, ConocoPhillips, and Marathon all seem to have the same issue as well, just not to the extent that ExxonMobil and Chevron have. Everyone's EVA spread seems to get larger every year as an industry ranging from negative 6.2 to negative 22.76. The most notable being Hess Corp at 22.76, negative 22.76, with a weighted average cost of capital at 9.4%. The only company higher than Hess is Marathon at a weighted average cost of capital of 10.9%, with equity playing a large role at 64.8% of that weight. All five companies' market-to-book ratio has remained somewhat steady throughout the years, the most notable being ExxonMobil with a solid market-to-book ratio above 2.0. Chevron and ExxonMobil are the only two with noteworthy enterprise values that are around 200,000. Looking at the dividend discount model for this industry, while using this model to look at future cash flows, ConocoPhillips has an implied growth rate of 26.501% with an expected return of negative 69.577% and an internal rate of return of 7.697 at a theoretical price of $5.70. Chevron also is the only one looking at the dividend discount model with a negative expected return of 30.77%. Their price to equity times their their earnings. Focusing on ExxonMobil's PE ratio at 40.76, a 10-year high. Their estimated earnings closing in 2015 at 3.85 still makes them the most beneficial company to invest in out of all five. So now I'm going to move to the second industry, my food, major diversified process and packaged goods industry. Again, this is the industry that I chose. This is General Mills Incorporated, Kellogg Company, Conagra Brands, Campbell Soup Company, and J.M. Smucker to represent this industry. Noting on their short-term solvency, looking at these ratios, with the current ratio, Kellogg Company has had the best record for their ability to pay off their short-term debt at 121. The other four companies are not far behind with this solvency. General Mills, J.M. Smucker, and Campbell Soup Company showing working capital issues. Conagra Brands looks to be the most solvent across the board, I found, with a quick ratio of 1.22 low and 1.45 high across 5 years. Conagra Brands seems to do the best job with keeping their company solvent at a consistent rate. Cash ratios across the board for this industry average at 1.03, also which Conagra Brands I found beats that industry average. Looking at long-term solvency, their total debt ratio, debt to equity, equity multiplier, 4 out of 5 companies do a really decent job not financing their assets with too much debt. Conagra Brands shows the largest numbers for improvement with their tier status from 1.11 to 1.43 for credit reasons. Campbell Soup Company and General Mills performed the worst in their total debt ratio at 1.34 and 1.17 respectively. The equity multiplier effect I found does not seem to slow any company down much, with the possible exception of J.M. Smucker. They seem to have some debt issues in the short run. That seems to be consistent with that company through really the past 7 or 8 years, I've found from Bloomberg. Just noting on total asset turnover again with their asset management, Kellogg has the most success I found at 0.87. This is actually not the norm for the industry at an industry average of just 0.41. Kellogg has been the most successful with that consistently across the board for the past 5 years. Taking a note at their profitability, looking at profit margins, return on equity, and return on assets, and decomprising their return on equity. What is really driving the massive return on equity for Campbell Soup Company, General Mills, and Kellogg seems to be a common theme of quality management, I found, as it shows up with their total asset turnover. Like I stated in the previous slide, Kellogg has the best total asset turnover. Also, Campbell Soup and General Mills have a above average total asset turnover, as well as their profit margins show in quality management, it seems, for those companies. All well above 15.84% as the industry average return on equity. Another factor, however, could be the low tax burden, something notable from the oil and gas industry as they struggle with a high tax burden. The return on assets for both JM Smucker, for all JM Smucker, Conagra Brands, and General Mills are below the industry average at 2.23%, 2.55%, and 2.41% for Smucker, Conagra Brands, and General Mills. Taking a look at their market value, this is again price to equity, market to book, EVA, their history. This year's estimate for the industry price to earnings is at a 23.14. Is pretty high for the industry. Both Campbell Soup Company and Kellogg outperform this with a strong price to equity of 25.17 and 27.66 respectively. Economic value added has increased for only General Mills from the past 3 years to 3,866. Economic value added history in respect to the other companies seem to remain constant throughout the years, with only the highest change at 79% for Kellogg Company. The spread of economic value added as well is constant, with the industry from negative 4.76 to 1.32. The weighted average cost of capital for all companies is relatively high for the industry at 12.34%, for the lowest of companies being General Mills. In addition, debt does not play a large role in anyone's weighted average cost of capital, I found, for the industry as a whole with these 5 companies. Kellogg and Conagra Brands opened the last 5 years with a strong market-to-book ratios at 1.67 and 2.01 respectively. Thenceforth, the ratios have fallen from that time, but Kellogg and Conagra Brands still do a decent job with that. Enterprise Values tells a similar story, as I repeatedly stated, from 146,000 to 102,774 for Conagra Brands. Looking at the dividend discount model for this industry, again, we're discounting back future cash flows for Kellogg Company, reveals an implied growth rate of 4.9%. They would have the largest expected return of 15.75% and an internal rate of return of 7.139% using a theoretical price of $87.10. The only company that comes close to matching Kellogg is General Mills at an expected return of 15.51%. Just noting quickly on their price to earnings times their earnings, their expected earnings, fixing on Kellogg's future cash flows as well as their strong, consistent return on equity and estimated earnings at 4.116 makes them the smartest buy. I think out of all five of these companies for this industry, I would go with Kellogg's company. And then, last but not least, the industry comparison for the two. I found that most companies have the highest market share, such as General Mills and ExxonMobil, take on more debt than they actually should. Um, they don't seem to be, especially with ExxonMobil, using debt very efficiently, as well as General Mills, but mainly ExxonMobil doesn't use debt very efficiently, and it looks like they're taking on more debt than they should. The oil and gas industry seems to lack, I found, where the processed and packaged goods industry soars. Um, Short term debt obligations as well as profitability differ greatly from one another. And so, from an investor perspective, I would choose the processed and packaged goods industry as a more risk adverse buy, as well as a smarter buy overall. Companies there seem to be a lot more conservative with their debt, and it's working out for them. In addition, the processed and packaged goods industry consistently performs on par or even outperforms the S&P 500, whereas I found the oil and gas industry underperforms or struggles to stay on par with the S&P 500. So again, I would choose the processed and packaged goods industry as the more risk adverse and the smartest buy out of both industries. Thank you.